Everyone knows Warren Buffett is rich, but if you invested $1,000 the way he does, would you actually be able to retire? On January 1st, 2026, the greatest investor of all time officially stepped away, leaving behind a $1 trillion empire and a portfolio that looks nothing like you'd expect. Forget what you've heard on the news. Today, we are looking at the actual SEC filings. If you want to know how the smartest money in history is playing 2026, you need to see this breakdown. I'm going through the portfolio ticker by ticker, exposing his massive sell-offs in tech, his surprising new bets, and finally, giving this entire strategy an objective rating on a scale of 1 to 10. We're going to see if the Buffett way is still the gold standard for your money in 2026, or if he's left the next generation with a sinking ship. The results might actually change how you invest this year. So let's finally look at the numbers. Before we look at the stocks, we have to look at the elephant in the room. The cash. As of February 2026, Berkshire Hathaway is sitting on a record $381.7 billion in cash and U.S. Treasury bills. To put that in perspective, Buffett could buy Disney, Uber, and Airbnb tomorrow in cash and still have money left over. This cash pile is roughly 135% larger than his entire equity portfolio. But why? In his final months, Buffett was a net seller of stocks for 12 straight quarters. This tells us two things. First, he thinks the 2026 market is overpriced. Second, he's giving his successor, Greg Abel, the ultimate dry powder to strike when the inevitable correction happens. If you're feeling pressured to be 100% invested right now, remember, the smartest man in history is currently 40% in cash. Now, let's look at the bedrock. Berkshire's public stock portfolio is valued at approximately $274 billion. While he holds over 110 different lines, 88% of his entire wealth is concentrated in just 10 names. Despite the headlines about him quitting tech, Buffett's legacy is still built on 4 massive pillars that make up nearly 56% of his entire equity portfolio. Apple, AAPL, 22.6%. This is the big shock. Even though he trimmed another 4% in the last quarter, Apple remains his #1 bet. He doesn't view this as a tech stock. He views it as a consumer utility. He's betting that in 2026, you'll give up your lunch before you give up your iPhone. American Express, AXP, 20.4%. This is one of Buffett's favorite moat businesses. Unlike Visa or MasterCard, Amex operates a closed-loop network. It issues the card, processes the transaction, and maintains the direct relationship with the cardholder. In a high-inflation 2026, Amex wins because as prices go up, their percentage fee on every swipe goes up too. Buffett originally invested in Amex during the 1960s salad oil scandal, and decades later it remains one of the highest conviction positions in the portfolio. Not because it's flashy, but because it compounds. Bank of America, BAC, 10.3%. He's been slashing this position lately, down nearly 30% from its peak, but it's still his favorite bank. Buffett's cost basis traces back to his 2011 crisis-era preferred deal, when Berkshire injected $5 billion into the bank during peak fear and received warrants at deeply discounted prices. That move alone generated billions in profit when converted. Coca-Cola, KO, 10.2%. Buffett first bought Coca-Cola in 1988, and it remains one of the longest-held core positions. With 63 consecutive years of dividend increases, Coca-Cola is part of the Dividend King category, a rare group of companies that have raised payouts for more than half a century. Even modest annual dividend growth compounds meaningfully over decades, and Berkshire now receives hundreds of millions annually in dividend income from this stake alone. In a recession, consumers may cut big purchases, but they don't stop buying beverages. Chevron CVX, approximately 7%. Berkshire increased its Chevron stake meaningfully in the fourth quarter, adding roughly 8 million shares compared with the prior quarter. Chevron's integrated business, upstream production plus refining plus chemicals, means it benefits both when oil prices rise and when refining margins widen. The move also came as other major positions were trimmed, making it one of the largest net purchases by Berkshire in that filing cycle. Occidental Petroleum, OXY, approximately 4%. Occidental has been a long-term energy exposure for Berkshire with the company. This represents a strategic emphasis on oil and gas producers, with shareholder returns tied closely to commodity cycles. Although the share count hasn't spiked recently, the existing position remains sizable compared with many other holdings. Chubb, CB, approximately 3.9%. Chubb was built quietly and increased again in Q4, making it one of the more active recent moves. Given Berkshire's foundation in insurance, this fits perfectly. Insurers generate float, premiums collected before claims are paid, which Buffett has long used as investable capital. Owning Chubb adds exposure to a well-run property and casualty insurer that produces steady underwriting profits and reliable cash flow. Kraft Heinz, KHC, approximately 2.8%. Buffett's Kraft Heinz position hasn't changed much in the recent filing, but it stands out for its consistent dividend yield and stable cash generation. While Buffett has been vocal in the past about operational disappointments at Kraft, and has even said he'd like to see structural changes there, Berkshire continues to hold one of the largest stakes among its consumer names, suggesting the company remains a core income-oriented position. Alphabet, GOOGL, approximately 2.0%. Alphabet, the parent of Google, has emerged as a steady technology holding. Buffett historically avoided big tech until recent years, but the position in Alphabet reflects either a strategic shift or confidence in the company's ad business, AI investments, and cash generation. It's one of the few non-financial/consumer staples tech names Berkshire holds with any material size. Moody's, MCO, approximately 1.5%. Moody's isn't a flashy company, but it functions as a kind of market toll booth, earning fees for credit ratings and risk data that almost every major financial institution requires. Its business model generates recurring revenue with high margins, which likely appeals to Berkshire's preference for predictable long-term cash flow, a core feature of many Buffett holdings. But to truly understand this portfolio, we have to look at what he's running away from. In his final quarter before retirement, Buffett didn't just trim, he slashed. In late 2025, Buffett slashed his Amazon AMZN stake by over 75%. While the world is obsessed with Amazon's AI cloud growth, Buffett's team is walking away. Interestingly, this position was originally managed by his lieutenants, not Buffett himself, and its aggressive liquidation suggests a major reassessment of tech valuations heading into 2026. He also continued to chip away at his favorite tech giant, Apple, selling another 10.3 million shares. Even though Apple is still his number one holding, he has now reduced this position for 3 consecutive quarters. Why? Valuation. With Apple trading at over 33 times its earnings, Buffett is choosing to lock in massive profits rather than bet on more frothy growth. Buffett also slashed his massive Bank of America stake by nearly 9%, offloading over 50 million shares in the fourth quarter of 2025 alone. This is a bank he has stood by since the 2011 financial crisis, so seeing him cut it by half since the middle of 2024 is a massive signal that he thinks bank valuations have finally hit a ceiling. Then there's the payments space. He didn't just trim, he essentially turned his back on the old toll booth model. He either fully exited or heavily reduced his longtime bets on Visa and MasterCard. For years, these were his favorite businesses because they take a small cut of every transaction globally, but by late 2025, he was clearly looking for the exit door. Why dump the winners? Because at his core, Buffett is a value investor, and in 2026, these companies are trading at multiples he simply can't justify. He's not saying they are bad companies. He's saying they are bad investments at these prices. By selling, he's choosing the guaranteed safety of a 5% yield on government bonds over a risky, expensive yield on overvalued tech. He is essentially cleaning the house for his successor, Greg Abel, leaving him with the most liquid, cash-heavy portfolio in Berkshire's history. So, what is the verdict? To find out, we're evaluating the legacy Buffett portfolio on 5 critical criteria. 1. Risk/reward ratio, 7 out of 10. First, let's talk about the balance of risk. Buffett's current ratio is fascinating because he has essentially de-risked the entire empire. By holding nearly $382 billion in cash, he's sacrificed the potential for massive high-reward gains in the tech sector to ensure he has a near-zero chance of a catastrophic loss. For a $1 trillion conglomerate, this is a masterclass in capital preservation, but for a smaller investor, the reward side of this equation might feel a bit stagnant while the rest of the market chases AI. 2. Safety and stability, 10 out of 10. When it comes to safety, this portfolio is an absolute fortress. It's anchored by what we call forever businesses, companies like Coca-Cola and American Express that have survived for over a century and pay rock-solid dividends even in the worst economies. Combined with a cash pile that earns roughly $20 billion a year in interest alone, this portfolio doesn't just survive market crashes, it thrives in them. If your goal is to never wake up worried about your bank balance, this is the 10 out of 10 gold standard. 3. Liquidity 10 out of 10. This is where Buffett truly stands alone. With the largest corporate war chest in U.S. history, his liquidity is effectively infinite. While other investors might get stuck in stocks during a downturn, Buffett is holding enough dry powder to buy entire companies like FedEx or Boeing in cash. This gives him the ultimate optionality, the ability to act when everyone else is paralyzed by fear. 4. Future-proofing 6 out of 10. Here is the weakest link. While the portfolio is safe, its future-proofing is a bit of a question mark. Buffett has historically avoided the circle of competence that includes cutting-edge AI or high-growth tech. While he has exposure through Apple and Alphabet, he's been aggressively trimming his tech positions lately. He's betting that the old world, insurance, railroads, and energy, will be just as important in 2030 as it is today. It's a conservative bet on the future rather than an innovative one. 5. Replicability 9 out of 10. Finally, can you actually do this? Surprisingly, the answer is a resounding yes. Unlike hedge funds that use complex derivatives, Buffett's primary tactic is doing nothing. He buys wonderful companies at fair prices and holds them forever. You can buy the exact same Big Four stocks, Apple, Amex, B of A, and Coke, on any trading app with as little as $500. The only thing you can't easily replicate is his insurance float. But for a retail investor, this is one of the most accessible big portfolios in the world. The final score, 8.4 out of 10. It is a legacy of safety. It may not make you a billionaire overnight, but it is built to ensure you never go broke. So, the real lesson from Buffett's 2026 legacy portfolio is the power of patience and liquidity. By sitting on $380 billion in cash, Buffett is telling us that the most valuable asset you can have right now isn't a hot stock. It's the ability to wait for the right opportunity. But listen, Buffett is just one side of the story. He's playing defense, but there are other big players out there playing a very aggressive game of offense. In my next video, we're going to expose a portfolio that is the complete opposite of this one. High risk, high tech, and potentially much higher reward. If this breakdown helped you see the market a little more clearly, hit that subscribe button and let me know in the comments. If you had to pick just one of Buffett's Big Four as your safest bet for the next 10 years, which one are you buying? If you found this breakdown valuable, check out the videos on your screen right now. They'll help keep your strategy sharp. I'll see you in the next one. Take care.